Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. I appreciate you all taking the time to join me today as we talk about a couple of very interesting topics. Performance measurements, and we'll be talking about responsibility accounting. A lot of fun topics today. I just wanted to kind of remind you where we are. So, this is the summer 2022 term. 6 week course. We're in week 5. Yay! We're in week 5. We're almost there. Can you believe it? Holy smokes. Um, a lot of you are so good. You're so nice to me, and you even do think not only do you do them on time, you work ahead. Some of you, which is amazing. And I appreciate that as well. I just want to call your attention to where we are. So we're doing chapters 24 and 25 this week. So, chapter 24, which is what we're about to talk about, instead of your usual homework assignment, which is 5 questions, true, false, multiple choice, you have it's short essays. Okay, it is a series of questions, and I want to open this up and show you what this looks like for those of you who haven't done it already. So it's 5 questions. They are open-ended, and they are intended for you to write a couple of sentences. I'm not looking for a lot, okay? It doesn't have to be, several paragraphs each. No, it's okay. I'm looking for about a couple sentences for each question. And I would like you to please include a reference or citation where you found it, right? Where you found that information. For each question, okay? So a couple sentences, reference, citation. That's what I'm looking for, ideally. Uh, if you already did it and you didn't do that, it's okay. Don't worry too much about it. But that's ideally what I'm looking for. A couple sentences with reference and citation for each question. Uh, that will help me to assess that you understand responsibility accounting and performance evaluations. So that's this assignment for what we're about to talk about. So I just want you to be aware that yes, this is a different type of assignment. And you see, it's worth more, right? This is worth 10 points. So instead of having another discussion board, this is a way to change things up a little bit. So hopefully you like this the way it's laid out. I personally like it myself, but it's just me. And of course, you have the PowerPoint presentations and the exercises to go along with each chapter. The exercises, again, you don't need to submit those. They're just there to help you practice what it is that you're learning. And I always recommend that you do those before you jump into the assignments for the chapters. Just kind of helps you to get a good understanding of what it is that you're looking at. So that's this week. Any questions? It's good, right? Easy, straightforward.
Yes, sir. All good.
Cool. Thank you. Okay, let's go ahead and talk about responsibility, performance measurement, responsibility accounting, which is what that homework assignment is all about with these short essays. Again, short essays, we're only talking like 2, 3 sentences per question and citations and references where you can get them in. Uh, so, performance measurement and responsibility accounting. Last week, we talked about a couple of different concepts. This week kind of builds on what you learned about last week when it comes to controllable costs and uncontrollable costs. That was one of the concepts we briefly talked about last week. And we're going to dive a little bit deeper into that through identifying uh, controllable costs and uncontrollable costs, direct expenses, indirect expenses. We're going to talk about who's responsible for those. That's what responsibility accounting means. Who's responsible for it? And we're also going to talk about uh, departments. So first, let's talk about the departments. I call these departments because think of like a department store, okay? Like a retail store, yeah? Let's say you go to Macy's. There's a couple different departments there, right? You have the jewelry department, the women's department, the men's department, children's department, home wares department, etc. I want you to departmentalize this concept, okay? So large companies are divided into departments because they're easier to manage. There's a manager of the men's department, a manager of the women's department, a manager of the jewelry department, a manager of the homewares department at Macy's. Each Macy's store has managers for each department. In addition to that, you have the store manager. The store manager is responsible for the whole store, and that person delegates to the department managers. Think of department managers like the next level down, right? And then below the department manager, sometimes you'll have supervisors, shift supervisors, morning, day shift, evening shift, or you might have supervisors for a couple of different products or line items, right? However they manage it, I'm not sure. But usually you have the store manager, then you have the department managers, and then you might have supervisors, and then you have all the employees. Okay, and that's typical. That's very normal of an organization to be organized in that kind of way, right? It's very top-down pyramid type of approach. It starts with the top level management and then goes down, 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 down. A lot of the decisions are delegated, right? That's very normal for a business. It's not the CEO isn't going to be doing a lot of the stuff. It's usually the department managers that do all the stuff, right? So most businesses are organized this way. It makes it easier to manage. You have different departments. The cool thing with this type of organization is the department managers are able to make decisions instead of all the decisions being made at the top level. Why is that cool? The department managers know their customers more than the CEO does. The department managers know their customers more than the store manager does. Okay? Because the department managers are closest to the product and they're closest to the customer. Right? That's why these types of organizations are easier to manage. So I always look at it from a retail perspective. I spent a lot of years working in retail. Moved my way through the ranks, started in sales, went up to supervisor, then a manager, and then eventually, store manager. Yeah, and then district manager even. And that experience, it was like this. There's a lot of different departments. Even when I was working in the hotel business, it was like this. We had a lot of different directors and managers within the different hotel departments. Front of house, back of house, rooms division, housekeeping. There's so many different departments in a hotel, as you know. And because there's so many different departments, they need department managers. So I would work with those managers and help the process. Within each department, there are profit centers and cost centers. Okay. A cost center is just as it sounds. It's all of the costs within that department. Okay, that's a cost center. Think of like the word center as a grouping. Okay, I group all the costs together in a cost center. Okay, within my department. And cost centers are just that. They identify all the different costs within that department. That's a cost center, okay? And the department manager is evaluated based on their ability to control costs. And as you know, there's a difference between controllable costs and uncontrollable costs. Controllable costs are the costs that can be controlled within the purview of that manager. Uncontrollable costs, those are out of their control. Those are things like a pandemic, or things like a meteor hit the store, or something like a recession. Those things are outside the manager's purview, outside of their control. All right. So the things that are in the manager's control, those are called controllable costs. Uncontrollable costs, well outside of their control. Examples of controllable costs. A manager has the ability to control the direct labor cost in that department. What I mean is they can control the number of hours employees work. They can control the amount of time the employees are spending on certain tasks. Okay, those are controllable costs. Direct labor is controllable costs. Other controllable costs could be things like cutting down on various expenses for that department. Like we can print less, that'll save office cost. We can do X, Y, and Z less, those will control those costs, right? Those are things that are controllable. An example of an uncontrollable cost, again, would be something like a pandemic, a recession, a meteor, act of God, right? So many different things can happen that are outside the purview. But also, another example of an uncontrollable cost could be the department manager's salary. Right? The department manager can't set or control their own salary. That's done above them. That's done at the store level. The store manager sets the department level salary. Or maybe that might not even be true. The salary might be set by the central home office, right? The corporate office sets the salaries. So an uncontrollable cost for a department manager would be their own salary. They can't control that. That's set by someone else. So those are examples of controllable costs and uncontrollable costs. And that's the cost center. Think of the cost center as lumping all of the costs together for that department. That's a cost center. And most departments have cost centers. Most departments. Most departments also have what's called a profit center. The profit center is exactly as it sounds. It's the sales. Okay, not all departments have sales. All right, but for the departments that do have sales, they have what's called a profit center. And I'm going to give you an example. The profit center of the women's clothing department consists of the sales made by the people working in the women's clothing department. Okay, that is the profit center for the women's clothing department. It's the sales made within the women's clothing department. That's the profit center for that department. The women's department manager will be evaluated based on their ability to generate income for that department. That's the concept behind the profit center. Okay. Now I said that most departments have a profit center if they're selling product or if they're selling product or service. For example, men's department, women's department, jewelry department, home goods department. They all have profit centers because they're selling product, they're selling inventory. Okay. Human resources, that department doesn't have a profit center. There's no generation of income from the human resources department. That's all expense. That's all cost. The accounting department, they don't have a profit center. The accountants aren't out there selling. They're just managing the cost. So, in other words, what I'm saying is, like, the support offices, like the accounting department, human resources department, engineering department, maintenance department, those departments, they don't have profit centers because they don't generate income for the store, right? Those would be identified using cost centers because they have costs associated with running those departments. That's usually related to the employees working in those departments and so forth and so on. But they won't have profit centers in those types of departments because they're support. So again, profit centers only belong to departments that are generating income. They're selling inventory. Women's department, men's department, clothing department, jewelry department, home goods department. They all have profit centers. They also have cost centers, but they have profit centers as well. The third center is called an investment center. Now, here's the thing about investment. As you know, in accounting, we can invest in our company through the purchase of property, plant, and equipment. Okay, investing. Think of on the statement of cash flows. On the statement of cash flows, you have operating activities, investing activities, and financing activities, as you recall, right? Now, I said investing activities. Investing activities include the purchase or sale of property, plant, and equipment. The same is true with the investment center within a business or within a department. As a department manager, you might have the ability to purchase property, plant, and equipment for your department. And you would be evaluated on the use of such an investment to help the company to generate income. Here's an example. Let's say you're a store manager, okay? And you worked with your jewelry department manager to purchase a display case for the jewelry department, okay? The display case is an asset. It's like a piece of, it's not quite machinery, but it's classified the same way. Because the only way for a jewelry department to generate solid income is to have display cases. Right? That's why when you walk into Macy's, you see, usually the first thing you see is the jewelry department or the perfume or the watches or whatever. As soon as you walk in, it's right there. Boom. There it is. Well, now why is that? Well, there's a couple of reasons why that is. But the point is, those display cases that you see when you walk into the store, those are assets used to generate income for the department, right? The reason for that is they put the jewelry in the display cases to attract customers to those cases to buy the jewelry, right? And so the store manager works with the jewelry department manager to purchase display cases for the jewelry. Those display cases are assets to the jewelry department. Okay. And so the jewelry department's performance is evaluated based on the jewelry department manager's ability to generate revenue using the display cases. Make sense? It makes sense, right? Oh, still with
Yes, sir.
me. Awesome. Thank you, Peter. Okay, so here's how, and this is why you see one in blue, the other one are like in this beige color or whatever. So cost centers and profit centers, they usually are always together in most departments, except for support departments like HR, accounting, the general office. You know, those those ones are only cost centers. They don't have profit centers with those because those support departments, they don't generate income, so they're only cost. The other departments like the women's clothing department, men's clothing department, jewelry department, home goods department, they have both profit centers and cost centers. Okay, because they both generate income and they also generate expenses. Separate from the cost and profit center, the investment center only gets utilized typically at the store manager level uh, for the purpose of investing in assets to help the department's collective generate income. So that's why you see it separated like that. That's how I want you to think about it, because it's the way it makes the most sense. Okay, as I talked about earlier, there are both controllable costs and uncontrollable costs. Controllable costs are costs that are within the purview of the manager. Okay, there are costs the manager can control. Examples would be things like hourly, uh, um, the amount of hours employees work in the department. Those are controllable costs. Uh, Example of that, when I was a department manager a long time ago, uh, I would have to send people home early, right? Why? It's slow, right? Those of you who work in retail, you hear what I'm saying, or who have retail experience, you hear what I'm saying. Oh, it's slow. Hey, why don't you think about taking off early? Okay, that's controllable cost, right? The department manager is controlling the cost, the labor cost. Uh, Other controllable costs, aside from labor, would be like the supplies used in the department. For example, I can print a lot less. I can just do it online, right? Those are controllable costs. Printing out handouts or whatever, controllable costs. So controllable, it's within the department manager's purview. All right. Uncontrollable costs are costs outside the department manager's purview. Examples would be the electric bill. The jewelry department manager can't control the lights being on for the whole store. That's uncontrollable for the department manager. Other uncontrollable costs would be things like the wages for the maintenance staff. They cover the whole store. That's outside the department manager's purview. Uncontrollable costs. Uh, the department manager's own salary. I'm sure they wish they could set their own salary, but they can't. So the department manager can't set their own salary. The store manager sets their salary typically, or sometimes even at the central office, headquarters, whatever. But the department manager can't set their own salary. The store manager sets their salary, or the manager above them does. So that's an uncontrollable cost for the department. So that's controllable costs and uncontrollable costs. We've talked about that a few times now, but I just want you to understand the difference. All of this information, controllable costs, uncontrollable cost, performance, all that is stored within the accounting information system. And the accounting information system helps to provide this type of information that helps to evaluate the performance of the department managers. Here's an example. Okay, when I was a department manager, long time ago, I was a Sears electronics department manager. Long time ago, okay? And back then, I would be evaluated by the store manager on my performance every month. Store manager would come to me and say, well, B, here's what we got going on. You sold X number of units of this, X number of units of this. You didn't sell any of this. You didn't sell any of this. This goes back to evaluating me on my profit center for the electronics department. And then the the store manager would say to me, well, B, your labor costs were this, hourly wages. Your labor costs were this, your maintenance cost was this, your storage cost was this, et cetera, et cetera. Now I'm being evaluated on my cost center, right, for my department. Those are my controllable costs, yeah? And then the store manager would say, so based off of the profit your department generated and your cost your department generated, this is how you did overall. Right? And that's how department managers get evaluated. Did they control their costs? How well did they control their costs? Did they generate revenue? How well did they generate revenue? So they're being evaluated on the profit center and the cost center. Again, not all departments have a profit center, but for those that do, they get evaluated on both. And so all of that information that the store manager was telling me came from the accounting information system, because you can break down the information by department. Sales by this department, sales by this department, cost by this department, cost by this department, etc. Now, as you know, a lot of organizations are pretty big. They can get pretty big anyway. And I'm going to keep using I'll use a couple different examples, but you could use Macy's as an example, I guess. Macy's has several different departments. Women's clothing department, men's clothing department, jewelry department, home goods department, etc. Each department has a department manager. Those department managers report to the store manager. The store managers report to the regional vice president. The regional vice president reports to the executive vice president for the nation. The national vice president reports to the president, and the president reports to the board of directors. And that's how it works. This is probably the exact diagram of how Macy's would operate. And they have different regions, and they got different regional managers, regional vice presidents, regional executive vice presidents, et cetera, et cetera. That's how it works, right? And you can drill down onto all the various levels to understand who's responsible for the cost, right? Like, for example, let's say you're in the corporate office for Macy's. You're in the corporate office and you get you're one of the many cost accountants for Macy's in your corporate office, and you get a report. It says, man, this one store in the Northeast, their costs for the men's department are out of control. you see like these crazy costs. But then you go, well, who's responsible for those costs? That's how we figure this out. Well, who's the executive VP for the country? Okay, who's the regional VP? Okay, who's the store manager? Who's the department manager? And then you start drilling down into the line items on the cost center for that department for that store. But yeah, this is how we figure out who's responsible for costs in a large organization. The response who's when we look at who's responsible, we also look at the amount of information that those managers receive. Think of like levels of detail. Okay, the closer you are to the product and to the customer, the more detail you receive. As a department manager at Sears in the electronics department, I can always tell how well I was doing. How? I looked at my sales reports. I looked at my expense reports to understand my profit center and my cost center. And in my profit center, I can look at what sold well, what didn't sell well. In my cost center, I can look at my labor costs, my other various costs. So as a department manager, I had the most detailed reports because I'm looking at everything on the product level or customer level. The store manager has access to those same reports, but they only want to see a summarized information of my department. Why? Because the store manager is responsible for all the departments. They don't want to just see the electronics department. They want to see the women's clothing department, men's clothing department, jewelry department, homewares department, all the other department reports. They receive the summarized versions because, first of all, they're too busy to look at just one. They don't want to see the detail level. They want to see the summary because they're responsible for the whole store, all the departments. Yeah. But it's and that's how it works in real life. It's very very realistic. So here's an example of a performance report. We can see at the very bottom of this, the department manager has the most detail, direct materials, direct labor, factory overhead for their department. All of that information, the totals, get rolled up to the regional level, okay, for that department across the region. And the department across the region has totals that come from other stores. So all the stores together rolls up into the region numbers that you see there at the very top. So the West region, beverage department for the West region, it all rolls up. It all rolls up. This kind of shows you like the difference in the various levels and the detail you see at the different levels. So now that you have a good understanding of profit centers, expense centers, and a little bit on investing centers, we talked about the cost center in detail. And we talk, and you know from previous conversations that companies have both direct costs and indirect costs. Direct costs are costs that I can trace to the product, right? Direct materials, direct labor, those are direct costs. Indirect costs I cannot trace directly to the product. That would be things like the supervisor's salaries, maintenance and repairs, etc., right? Indirect. We can do the same thing for the departments. I can trace direct expenses to the departments, and indirect expenses can be allocated to the departments. So let me show you the example. Okay. So direct costs, I can trace them directly to the department in which they were incurred. And direct costs are spread across the departments or allocated because they're a joint effort. Here's what I mean by this. Examples of direct expenses would include things like the hourly wages for the people that work in that department, the amount of materials used in that department, right? Those are direct expenses. I can trace those right to that department. Indirect expenses that I cannot directly trace would be things like the wages and salaries for the store manager and the support staff, the rent for the store, the utilities used, like the electric, the water, whatever, advertising for the store, and depreciation of assets used for the store. Those are all indirect expenses. They're indirect because I can't trace them directly to the department. However, I can allocate a portion of those expenses to the department. And here's how I do that. For wages and salaries, I take the total wages and salaries for the store and divide by the amount of hours worked in each department. And then I allocate a percentage of that to each department. I do that for the store manager, basically, right? For rent, I take the square feet of the space occupied by the department. Okay, here's how that works. It's going to work the same way for utilities. But here's how this works. Let's say I have, I grab my calculator. I don't need my calculator. Yes, sir. Grab my calculator, okay? Let's say, for example, and this is how it works in real life too. Let's say I got a store, Macy's. I have a Macy's store. It's 100,000 square feet. It's a big store. Sure is. Okay. 100,000 square feet. The total square foot of the store is 100,000 square feet. Let's say the rent for my Macy's store, so it's in a mall, I gotta pay rent. The mall charges me, we'll say $300,000 a month for rent. I take that amount and I divide that by my total square foot, 100,000. Means my total rent per square foot is $3. So $3 per square foot is my rent amount each month. My jewelry department in my Macy's store is 200 square feet. It's not very big. It's usually not. So my jewelry department is only 200 square feet. If my rent is $300,000 a month, my total square footage of my whole store is 100,000 square feet. That means that my rent per square foot is $3. If my jewelry department is 200 square feet, I take my $3 and I multiply that by 200. Oh, sorry. 3 times 200 is $600. So I allocate $600 to rent for the jewelry department. And I follow the same logic for the utility bills. I get the utility bill in, I divide that by the 100,000 square feet, I multiply that by the square footage of that department to find the utility allocation. Make sense? Understand how we do the allocations for indirect expenses so far?
Yes, sir.
Awesome. Thank you very much. Very cool. Okay. So direct and indirect expenses can be allocated to the departments. Direct expenses, as you know, are allocated based off of their usage. Hourly wages, materials used, those are the direct expenses. Indirect expenses are allocated based on the allocation base and the total to allocate. And of course, the reason why we allocate in the first place is because we need to understand the cost center for each department. It helps us as managers to better understand how efficient our departments are being run. That's the real reason why we do it. So, how do we figure out how much cost to allocate? We take the total cost to allocate and we multiply that by the percentage of the allocation base used. It gets a little complex, but my earlier example is probably the easiest one to follow. It's really just instead of doing it in one formula, I tried to break it out into two just to make it easier for you. So I'm going to show you some examples on how we allocate the indirect expenses. So we talked about rent, utilities, wages, advertising, and depreciation. Now remember, we also need to allocate the service departments. Service departments, as I had said earlier, well, I call them support departments. It's the same thing. A support department, or service department in this case, are departments that support the operation. That would be the accounting department, human resources department, the back end office. Those departments, they help to support the store, right? The whole store. Let's say the accounting office doesn't just help the jewelry department, they help the whole store. Human resources doesn't just help the men's department, they help the whole store. Same with the maintenance department, the office department, they help the whole store. So we need to fairly allocate the service department expenses as well to the departments. What I mean by that is we need to take the expenses that were incurred by the support department, service department, and allocate them to the departments that generate revenue. Men's department, women's department, jewelry department, homewares department, etc. And the way that we allocate those expenses is through the allocation base. Now, here's how it works. For example, the back office department. Our allocation base that we're using are the number of employees in each department. It's a fair base. Personnel expenses. Again, we're looking at the number of employees in each department. Payroll expenses. The number of employees in each department. Purchasing costs. We base it off of the dollar amounts of purchases or number of purchase orders. And the maintenance expense, our allocation base is the square footage of each department, similar to the way we did rent and utilities. So, in addition to the indirect expenses, we also allocate the expenses generated by the service or support departments. Here's an example. It just so happens to be a jewelry department. Oh, no, I'm sorry. This is a jewelry store. But within the jewelry store, they have a few different departments. So here, this jewelry store, oh, it's classic jewelry. We received a bill for janitorial services to clean the store for $800. We do that every month. You know, oh, it's nice to have somebody come in and clean the display cases and, you know, vacuum the floor and wipe down the windows and et cetera, et cetera, et cetera. So they come and take care of my whole store for $800 a month. And I have them show up, 3 times a week. Pretty good deal, in my opinion. We need to allocate our cost of this $800 a month to our various departments. We have 3 departments in our store. We have the jewelry department, the watch repair department, and we also sell china and silver. I don't know why they sell china and silver. It's kind of weird for a jewelry department, whatever. Or I'm sorry, jewelry store. So we need to allocate our $800 bill that we got for cleaning services. And the way we do that is based off of the square foot of each department. Our store looks like it's a total of 4,000 square feet. It's a decent sized jewelry store. So 4,000 square feet. And we know what the square foot of each department is. 2,400 for jewelry, 600 for watch repair, and 1,000 for china and silver. You could also figure out the percentage of the total square feet. The way to do that is you take the square foot for the department and divide by the total square feet. So 2,400 divided by 4,000 is 0.6, also known as 60%. 600 divided by 4,000 is 15%. 1,000 divided by 4,000, that's 25%. So now we have the percentage of the total square feet for each department. To allocate the total $800 bill that we received for the whole store, we do that based off of the percentage of the total square feet. So the bill was $800. To figure out how much to give the jewelry department, we take the $800 and we multiply that by the 60%, which is the percentage of the total square feet for that department. So 800 times 0.6 is $480. 800 times 0.15 is $120. And 800 times 0.25 is 200. So that's how we allocate an indirect expense, like janitorial services, to the individual departments. Make sense? Good, right? So I hope this is straightforward. I'm sure it probably is. All right. Now, each department, as you know, is recognized as a profit center and a cost center, unless it's a support or service department. But the other departments are recognized as both the cost and a profit center. It's a profit center because it generates income. It's a cost center because it also produces expenses. So I can prepare individual income statements for each department. And I do that by looking at the income, revenue, and direct expenses for each department. And then I allocate the indirect expenses to the departments for both the support departments and the operating departments. And then I can generate this income statement for that department. So here's how it looks. I got my sales for each department. This example comes from, we'll call it Ace Hardware. So Ace Hardware, they have 3 departments: hardware, housewares, and appliances. Each of those departments generates sales. Hardware department generated $119,500, houseware $71,700, and appliances $47,800. Now, of course, each of those departments also has direct expenses: cost of goods sold, salaries, depreciation expense, supplies. Those are all direct expenses. I could trace those directly to each department. So I do that. Now, I also have support departments. I got my general office and I have my accounting. And I allocate, those, they have their direct expenses as well. And of course, I also have indirect expenses that I'll eventually allocate to the service department, to the operating departments: rent, utilities, advertising, insurance. So what do? I got to allocate my indirect expenses to the departments. Rent expense is done by square foot. Utilities done by square foot. Advertising is done by percentage of sales. And insurance expense is done by value of insured assets in the departments. So we take those expenses, the indirect expenses, and we spread them across all the departments. Then the third step is we got to take our support department expenses and allocate those to our departments, to our actual departments: hardware, housewares, appliances. And we do those based off of sales and purchase orders. And then once those steps are done, I can generate the income statement for the departments. We have sales minus cost of goods sold equals gross profit minus all of your various operating expenses equals net income, or operating income, I should say. See how that works? Yeah, I mean, this is how it's done. This is how it's done, especially in large companies that have a lot of departments. We did the same thing in the hotel business. And that was what we had to do. We did the same thing in the retail business. It works the same way.
Question, sir.
Yes, Peter, please.
So with these larger companies, do you generally see, say, one accountant, or do they generally like build a team to kind of work on this?
It depends. It depends on the size of the company. Like if it's someone like Macy's, for example, they at the Macy's corporate office they have a team of accountants. And this is what they do. Um, and it's pretty easy for the most part to generate these types of reports because it's based off of the information that you put into your accounting system. So, as you know, in a large retailer like Macy's, their accounting system is driven by the point of sales, right? The cash register. Cash register records all of the transactions for you. You scan the barcode, takes it out of inventory, which puts it into cost of goods sold. We collect the revenue, sales from the customer. So sales minus cost of goods sold equals gross profit. We can do that as soon as we scan the barcode, right, for each product. And it totals up over the day, course of the day, and then we submit all that stuff, we transmit all the data at night to the corporate office. That's the sales part. Then, of course, we have all of the expenses. We don't know the expenses until the end of the month when we punch in all of our bills, right? The utilities, the rent, the whatever, whatever, whatever. And of course, we do a general journal entry for all of the payroll data, which comes from our HR department at our store. Once all that information is entered into our accounting information system at the end of each month, that information rolls up to the corporate office. The corporate office can then generate the income statement for each department. And it's just a matter of how it's classified within their accounting system. Because and here's how that works, right? So the customer comes to the counter, you scan the barcode. When you scan the barcode says what department it came from. So you just scanned a woman's blouse, so it got allocated to the women's department. Or you just scanned a man's trousers, so that got allocated to the men's department. You just scanned a piece of jewelry, so it got allocated to the jewelry department, so forth and so on. And so there's a lot of data like that gets entered into the accounting system that makes it easy for the people at the corporate office to then generate the individual department income statements uh, in that manner. So that's how it works. And so to answer your question, yeah, typically for like a large organization, there's going to be a team of accountants and that's what they do, right? And for smaller organizations, let's say it's like a local chain. Let's say it's Lido Pizza, okay? Lido Pizza, they're only in our region. They're only in the D.C. region. We got them in Maryland, D.C., Virginia, and that pizza chain, they have I know for a fact they have a corporate office in Prince George's County, and at their corporate office they have a couple of accountants, and those accountants they do things like that, but it's for the individual stores because obviously it's the same product, right? But the same concept applies. So to answer your question, it depends on the size of the operation. But if it's a smaller or operation like one store, it's probably just that store owner that's doing that. But yeah, excellent question. Does that help to answer your question, Peter?
Yes, sir. Also, if when you're scaling up to maybe say going from a smaller business to maybe three, four, or five franchises, would you be allowing a little bit more leeway for, I guess, loss or because I'm wondering with more hands on, say, registers and more cash transactions, would you just assume that there would be more loss involved or?
Yeah, well, that goes kind of into your risk calculation. So the short answer is no, because you would expect that as you've got more stores coming online, that they'll be the franchisees, the people running the franchise stores, would receive guidelines, right, from the franchisor person doing at the corporate office. And those set of guidelines are probably going to be very clear, how to control things like possible theft or what the protocols are for when your books don't balance, the cash register doesn't balance, whatever. So I would say, Peter, to a degree of certainty, that it would be like the very first store that opened, and that every store thereafter would be within those parameters. So the short answer is no. I don't think that there would be um, any additional wiggle room, so to speak, for loss. Good question. Good question.
Thank you.
Yeah, absolutely. My pleasure. So along those lines, we talked about the income statement. So yeah, there's contribution margin, right, that is generated by each department, and it's just department revenue minus direct expenses gives you your department contribution margin. Uh, it's used as a functional equation just to kind of give you a really quick idea of how well the department is functioning. Department revenue needs to be greater than their expenses to obviously help generate a profit. If the department contribution margin is ever negative, that department ain't going to be around too much longer, right? We can't have losing departments. It's like, well, if the jewelry department ain't making me money no more, I ain't gonna have it around. So that's the reason why that exists, that those type of calculations exist. Oh, sorry. Um, this is an example of a contribution margin for department sales minus your direct expenses gives you the contribution margin for that department. Uh, so we can see just looking at this for Ace Hardware, we got hardware, housewares, appliances. They're all looking good. Our sales are greater than our direct expenses in all three of those departments. The appliance department looking a little light, but you know, if that 9,500 ever went negative, I'd probably stop selling appliances. That just means you're no longer selling them. Uh, but this is a really quick and easy way to figure out how well the departments are doing. For your investment centers, we talked about this. So as you know, investment centers, that's when we're purchasing property, plant, and equipment to invest into the departments, right? They help us to generate income, revenue. The formulas that we would use to understand if the investment center is working out well would be things like return on investment, residual income, profit margin, and the investment turnover ratio. Those ratios really help us to understand how well our investment centers are doing. Return on investment uh, is investment center income, so the income generated from the asset that we purchased, divided by the investment center average invested assets. And it's a whole mouthful, I know. Remember, when you see that word average, we're looking at beginning balance plus ending balance divided by 2. The word average, right? Beginning balance plus end balance divided by 2. That gives you the average, especially when we're talking about assets. So in this example that we're looking at a phone manufacturer. Let's just call it the iPhone, right? They make iPhones, and the iPhone has an LCD screen and the phone itself, right? The components. And we can figure out which department within the division that makes the iPhone. We can look at the departments to tell us how well they're utilizing those components, right? So the screens, the LCD screens, 21% ROI, and the phone components themselves, 23% ROI. So we can see that they're both doing quite well. Residual income, another great way to identify how well your investments are doing into your company. Residual income, we take net income from the investment center, which is the income generated from our assets, minus the target investment center income, which is usually predetermined by your board or from your president or managers. And it's usually expressed as a percentage of the total investment. That's your target investment income. Think of it like target profit, right? We talked about that when we talked about sales a couple weeks ago. We take investment center income minus our target profit or target income equals our residual income. Remember, the word residual means additional. So ROI can also be expressed as the profit margin times the investment turnover. Profit margin, as you know, is income divided by sales. And the investment turnover is sales divided by average assets. You see the word average. It's beginning balance plus ending balance divided by 2. Oh, this one's cool. The balance scorecard. Now, as you know, in business, we can't just evaluate the performance of our business on financial information. I wish we could, but we can't. I can't tell you, and we can get a pretty good idea. Like, I can look at an income statement and say, yeah, the company seems like it's doing pretty well. I can look at the balance sheet and say, yeah, it's doing pretty good. Statement of cash flow, sure. The financial data is only a small piece of the picture. Okay. I can get an idea from the net income, return on investment, sales, growth, cash flows, residual income, stock price, etc. That's all the financial stuff. That's what we've been talking about for the past couple weeks. It's only a small piece of the picture when it comes to the performance of the company. I also look at things like customers, the internal processes, and research and development, also known as innovation and learning. For my customers, I look at things like, are they satisfied? How many new customers did I get this month? What was the percentage of on-time deliveries, percentage of sales from new products? How long did it take me to get the order to the customer? What was the percentage of sales that came back from our customers? That type of data tells you the level of relationship between the company and your customer. I also look at things like our internal processes. It'll include things like defect rates, cycle time, product costs. Product costs is a big one. Labor hours per order. How long is it taking our employees to complete each customer order? And how many days we went without an accident. Yeah. So it's sad but true. But all that information tells us how well we are executing our plan, right? How well we're working, as they say. And then one of the other things I look at is what research and development. Within research and development, we're looking at things like, are our employees happy? How long do our employees work here for? Employee turnover. How much money do we spend on training per employee? How many of new products has our company developed? What's the number of patents that our company has? And how much did we spend on research and development? That tells us, is the company progressing forward, right? So again, we can't just look at the financial data of the company. We need to look at the company as a whole, right? So that's why we look at all of this data to really tell us how well is the company performing? And Giovanni, I know that you and I had a conversation the other day around this. We talked about investing for a little bit. Say, oh, what's the company say? Look into investing and, all that type of thing. And the answer really is it's a multifaceted approach. We can't just take the financial data. I mean, yeah, you can look at all the financial data, but it doesn't tell you the whole picture. That's why you look at things like the manager's discussion, the managerial discussion and analysis, and the 10K report. You'll look at earnings calls. You'll look at things like press releases. All of that information kind of looks at what we're talking about right here with the balanced scorecard. You're not going to find it all in one place, but when you look at all of the data collectively about the company, it really gives you a good idea if the company's worth investing in or not as a potential shareholder. So things to think about, like when you're looking at your 401k or your retirement plan, or if you want to buy single stocks and things like that. This is a great way to kind of analyze a company's performance, because I personally don't invest in companies that aren't doing well. And I can tell if a company's doing well by looking at this kind of data. Transfer pricing. I got to talk about transfer pricing briefly. You'll see one question about transfer pricing. I think there's one on homework, but in addition to that, you'll see one on the final exam. So transfer pricing. Let's say we have a large company, okay? I got two facilities that manufacture product. I got one facility that manufactures the screens that go on my iPhone. And I got one factory that develops the phone itself, the components, if you will. Both factories are capable of producing large quantities. Sometimes one of my facilities will be at capacity. I can't produce anymore. I'm maxed out. I'm at my maximum capacity. When that happens, we look at a process called transfer pricing. And this happens when I need to move my production from one facility to another. And oftentimes, this is negotiated between the managers of each facility. Sometimes it's dictated based off of the market price. We always go for the less of the two, but these are what dictates price when it comes to transferring product from one division to another. And the only reason why we transfer is based off of capacity. So here's some information, in terms of an example. We have capacity, the sales price to outside customers, and the variable cost of manufacturing per unit. We also have fixed cost of manufacture. We look at all that data to understand if it's feasible for one facility over the other to keep manufacturing it, or do I need to go outside to another manufacturer to help me out in terms of meeting my demand. Transfer pricing. I'm not going to dive too deep into that because it's a very complex topic, more for an advanced accounting course. Cash conversion. This formula tells me how quickly I'm converting my sales into cash. There's a couple of formulas within cash conversion that we look at that help us to formulate the cash conversion cycle. The cash conversion cycle is days sales and accounts receivable, how long it's been sitting in accounts receivable for before it's been collected, plus the days sales and inventory, how long is my inventory sitting on the shelves, minus the number of sales and accounts, number of days in accounts payable, how long it's been since I've been paying my bills. Those three together equal the cash conversion cycle. You have to do one at a time, and each one is based off of a different formula. Yeah. But again, that's helpful for telling me how quickly I'm able to collect cash. There's the time it takes to get cash coming in. So we do day sales first, day sales and inventory, and then we do day sales and accounts payable to get the conversion cycle. We typically aim for a short conversion cycle. Cost allocations, we talked about those. It's with the total amount to allocate times the percentage of the allocation base. I gave you those awesome examples with the jewelry stores. Try to remember those ones. And the Macy's. Try to remember those examples. The allocation base is used. How do we allocate rent based off the square foot for each department? How do we allocate utilities based off the square foot for each department? How do we allocate advertising based off of sales, total sales? Allocation of insurance based off of the value of insured assets. How do we allocate our service departments, right? Based off of things like number of purchase orders or number of payroll employees in each department. So purchase orders, payroll in each department, etc. And this is what I was telling you about transfer pricing. The two managers negotiate, and it's usually at cost. Sometimes it might be a little bit more, but it's never above market price. And that's how transfer pricing works. Again, not going to get too deep into it in this course, but I just want to kind of give you an understanding of how transfer pricing works. These days, it's not terribly commonly used among a single company, but sometimes transfer pricing might come into play currently if your company manufactures a product and you're at your maximum capacity. You can't make any more. Okay. When that happens, then you got to reach to an outside third-party manufacturer. Say, hey, this is what I'm making. I need you to make this for me. And that's where transfer pricing comes into play. One other thing. So we talked about allocating costs for indirect costs for the departments. There's one other concept is called joint costs. Joint costs are costs that are shared across the departments. Okay. An example of that would be the store manager's salary. That gets split across evenly to the individual departments. Joint cost. The lumber example is okay, but I like the store manager's salary. And that can be based off of something like square footage. Okay. That, my friends, is the end of our conversation on performance management and responsibility accounting. Any comments, questions, or concerns? You're all good with this part? Okay. Let me go ahead and stop the recording here, and we'll start the next one.